All right, so let's dive into a company that's been making headlines, but for some pretty puzzling reasons. Deere Company.
Deere Company.
You know them, they make those big green tractors you see out in the fields.
Yeah.
Well, their stock has been on a bit of a roller coaster lately, up 21% in the last 3 months. But here's the thing that's got me scratching my head.
What's that?
Their earnings are actually down.
Interesting.
Yeah. So we're going to take a deep dive today into their recent performance, that surprising stock surge, and what it all means for you as an investor.
You know what I find really interesting about this whole situation?
Yeah.
Is that it reminds us of something we often forget. The stock market, it's not always a perfect reflection of how a company is doing right now financially.
That's true.
It's more about expectations, future potential, and sometimes even a bit of good old-fashioned psychology.
Okay, so let's rewind for a second.
All right.
Deere's stock price was basically flatlining for over 3 years.
Wow.
Can you believe that?
That's a long time.
And this was despite them bringing in record earnings back in fiscal 2023. It's like Wall Street was totally unimpressed.
Yeah, it sounds like the market had already factored in that huge gross from Deere.
Yeah.
They were the star performer. So
Right.
Investors had set the bar really high, and just meeting those expectations wasn't enough to keep that stock price climbing.
So basically, investors were saying, Deere, we already know you're awesome. Show us something new.
Exactly. And that's where things get really interesting. Deere comes out and predicts lower earnings for 2025, and you'd think that would send the stock plummeting, right?
Right.
But instead it takes off.
Yeah, that's the part that really threw me. How does that even make sense? Earnings are down, but the stock is up.
Well, this is where the psychology of the market really comes into play. Think of it this way. Expectations for Deere had gotten so negative, so focused on potential downsides, that any news that wasn't a complete disaster was suddenly seen as a reason to celebrate.
So it's like a relief rally.
Exactly.
Everyone was braced for the worst, and when it wasn't as bad as they feared, they jumped back into the stock.
That's a great way to put it. And it shows how a company's stock performance can sometimes be the opposite of its earnings, at least in the short term.
So let's say someone is looking at Deere stock right now.
Okay.
Earnings are still projected to be lower in 2025. What should they be thinking about?
That's the million-dollar question, isn't it?
Yeah.
And to answer it, you have to zoom out and consider Deere's long-term prospects, not just the immediate bumps in the road.
Okay, so let's unpack that. What are some of the factors that are shaping Deere's long-term outlook?
Well, first off, you got to remember that the industries Deere operates in agriculture, construction, forestry, they're all cyclical by nature.
Right.
They go through natural upswings and downswings.
So even if things are a bit slow right now, it doesn't mean it's going to stay that way forever.
Exactly. And then you've got those external factors like the possibility of trade wars.
Oh, yeah, that's a big one.
That's a real wild card that could have a big impact on Deere's international business, especially if tariffs make their equipment more expensive in foreign markets.
Right, makes sense. But Deere's also got some pretty impressive strengths working in their favor too, right?
For sure.
I mean, they've got this long history of innovation, and they've been really good to their shareholders with things like buybacks and dividends.
Absolutely. In fact, they've managed to reduce their share count by over 20% over the past decade.
Wow, that's a significant chunk.
Yeah.
Can you break that down for investors who might not be familiar with share buybacks?
Sure. When a company buys back its own shares, it's like shrinking the total number of slices in the pie.
I see.
And that means each remaining share represents a bigger piece of the company's earnings.
So even if Deere's overall earnings might dip a bit in the short term, each share is worth more because it represents a larger ownership stake.
Exactly. And this ties into another fascinating aspect of Deere's strategy, their focus on U.S.-based manufacturing. In their recent earnings, called their CEO, John May, he pointed out that over 75% of what they sell in the U.S. is actually made right here in the U.S.
That's interesting.
It is. It goes back to those trade war risks we were talking about. If tariffs increase the cost of importing heavy machinery, Deere is in a really strategic position.
Because they're already making most of their products domestically.
That's right.
So even though Deere's earnings might be down in the short term, they're making some strategic moves that could really pay off in the long run. It's like they're playing a different game than some of their competitors.
That's a great way to put it. They're not just reacting to the market. They're trying to anticipate it and shape it.
And that makes them a fascinating company to watch for any investor who's trying to figure out how to evaluate a company's true potential.
Absolutely.
All right, so we've got this mix of factors at play here. A cyclical industry, the threat of trade wars, a history of innovation, and a strategic bet on U.S.-based manufacturing. Where do we go from here? What are some of the key things investors should be watching for when it comes to Deere?
Well, those are some great questions, and we're going to tackle those and more right after this.
Sounds good. Okay, so we've talked about the roller coaster of Deere's stock price and how it's not always a direct reflection of their earnings. What really piqued my curiosity is this whole focus on U.S.-based manufacturing. It's almost like they're making a bold statement. We believe in American-made.
Yeah, it's a really interesting strategy, and it could have ripple effects across other industries.
Yeah.
We've got to remember the context here. Rising trade tensions, concerns about supply chain vulnerabilities, and a growing emphasis on domestic production. Deere seems to be positioning themselves as a leader in this shift.
And that quote from their CEO, John May, really stuck with me. Something like 75% of what they sell in the U.S. is assembled right here in the U.S. That's a pretty impressive commitment.
It really is. And, it speaks to a broader trend. We're seeing companies are starting to rethink their global supply chains and consider the advantages of bringing production closer to home.
I can definitely see the appeal of that, especially with all the uncertainty in the world right now. But wouldn't shifting to more U.S.-based manufacturing also lead to higher costs for Deere? I mean, labor costs are generally higher here in the U.S. compared to some other countries.
That's a valid point. And it's definitely a trade-off that Deere will have to manage carefully. But there are also some potential cost advantages to consider.
Oh, like what?
Well, for example, by reducing their reliance on global shipping, they can avoid those rising transportation costs and potential disruptions, things like port congestion or geopolitical instability.
Right. So it's not a simple equation. There are definitely pros and cons to both approaches.
Exactly. And I think Deere is betting that the long-term benefits of U.S.-based manufacturing will outweigh the potential cost increases. Things like greater control over their supply chain, increased agility, and maybe even a Made in America premium for their products.
It's a bold move for sure. But Deere has that history of innovation, and they've always found ways to adapt and stay ahead. So maybe they're onto something here. What do you think our listeners should be paying attention to in order to assess whether this strategy is actually paying off for Deere?
That's a really great question. One key thing to watch is their profit margins. If they're able to maintain healthy margins, even with those potentially higher labor costs, it would suggest that they're finding ways to offset those costs, maybe through efficiency gains, automation, or pricing power.
So it's not just about whether they're making products in the U.S., it's about doing it in a way that makes sense financially in the long run.
Exactly. And another thing to keep an eye on is how this U.S.-based manufacturing strategy impacts their brand perception and market share. If customers respond positively to that Made in America message, and Deere is able to gain market share from competitors who are more reliant on global supply chains, that would be a strong signal that their strategy is working.
It's almost like they're trying to flip the script and turn a potential challenge, those rising trade tensions, and the push for domestic production into a competitive advantage.
That's exactly right. And that's what makes this story so interesting. Deere isn't just reacting to the market. They're trying to proactively shape it. They're betting on a future where U.S.-based manufacturing is a key player, and they're putting their resources behind that vision.
It's definitely a risky bet, but if it works out, it could have huge implications, not just for Deere, but for the entire manufacturing world. And for investors, it's a good reminder that sometimes the most exciting opportunities are in those companies that are willing to go against the grain and forge a new path.
Absolutely. Deere's story is like a case study in how companies can adapt and evolve in response to these changing global dynamics and potentially turn obstacles into advantages. It also highlights how investing is about more than just crunching numbers. It's about understanding the bigger picture, identifying those emerging trends, and evaluating a company's ability to navigate a complex world.
Speaking of navigating a complex world, let's talk about some of the specific risks that Deere is up against. We've touched on trade wars and their potential impact on their international business, but what are some other things that could throw a wrench in their plans?
Yeah, there are definitely some potential headwinds that Deere needs to be prepared for. One of the biggest ones is their dependence on a strong global economy. I mean, if we see a major downturn, that could really hurt demand for their equipment.
Makes sense. Farmers might not be as eager to buy new tractors if they're not getting good prices for their crops.
Exactly. Construction projects could get put on hold. Logging activity might slow down. It's a tough situation for any company in those industries.
So basically their success is tied to things that are completely out of their control.
To a certain extent, yes. It's a good reminder that even the best-run companies can be vulnerable to those big economic swings. And another risk to think about is competition. Deere's a big player, but they're not the only one.
Right. They've got competitors all over the world.
Exactly. Yeah. And with technology evolving so rapidly, there's always the chance that some new disruptive competitor could come out of nowhere.
Like some startup with some super advanced automation or maybe electric-powered equipment.
You got Disruption can happen fast, and it often comes from places you least expect it.
Yeah.
So even though Deere is investing a lot in research and development to stay ahead of the game, there's always that risk that someone else could leapfrog them.
It's like they say, what got you here won't get you there. So for our listener who's thinking about Deere but also wants to be a smart investor, what are some key takeaways from all of this?
Well, I think one of the biggest lessons here is that expectations really matter. We saw how Deere's stock price actually went up even though their earnings were down. That tells us that understanding investor psychology is just as important as looking at the financials.
So it's not just about the numbers, it's about the whole narrative surrounding the company.
Right. And another important thing to keep in mind is that investing is a long game. Deere's making some big bets on the future, especially with this focus on U.S. manufacturing and automation.
Right. It might take a while for those investments to really pay off.
Exactly. So you got to be patient and look at the big picture. And finally, I think Deere's story shows us how crucial it is to understand the world that a company operates in.
They're facing some tough challenges like trade wars, a potential recession, and fierce competition. But they're also taking advantage of opportunities like this push for American-made products and the increasing demand for automation.
Absolutely. It's all connected. So yeah, investing isn't just about picking stocks. It's about seeing how all these pieces fit together.
It's about connecting those dots, looking beyond the headlines, and understanding those bigger forces that are shaping industries and the global economy as a whole. Well, we've covered a lot of ground today, from that unexpected jump in Deere stock price to their strategic focus on U.S. manufacturing and all the risks and opportunities they're facing in this rapidly changing world. Hopefully our listener has some new insights and things to think about as they continue their investing journey. And of course, we're just scratching the surface here. Always do your own research, consider your investment goals and risk tolerance, and never be afraid to ask questions and really dig deep into those companies you're interested in. Thanks for joining us, Ashar.